Welcome back, everyone. It's been a while since I've done a market update, and so today I'm doing one titled, Is Winter Coming? I think you'll see why as I go through the video, but basically, all may not be perfect in the broader market. Look, I think many of you that have seen videos recently have probably noticed more caution in what I've been saying. Look, a few months ago I said I'm targeting to move a third to more defensive. I recently talked about shopping for gold. I talked about buying real estate equities and not hyper-cyclical, little stocks. It's the nicest way I can say it. And then recently I said I'm selling steel, even though I really like the stock. And so I'm going to walk through a bit of why these things and what is kind of making me think. So first, as I'm sure a number of things in this video will not make some people happy, I want to say from the beginning, I recognize I can't know for sure. I don't think you can know for sure. No one can know for sure what's going to happen. So the market is all about price and probability. And for me, the recognition that I can't know things has allowed me to avoid some mistakes and take some risks at times when the market was not pricing in success. So I don't know what's going to happen going forward in the broader market, but I'm starting to get the feeling that some more caution may be needed in the coming months. And here's why. Look, a year ago, if we can remember back that far, it seems like 4 years has happened in the past 13 months, but the market was at its lows. Then it came roaring back because what happened? Well, we didn't get the depression that it was pricing in. So you had commodities that were well below the marginal cost of production, pricing in, okay, we need to stop now. And then turns out, well, supply was constrained too, and everything came rocketing back. And you know what? That made perfect sense because the rocketing back made sense because we had the greatest economic micro boom ever. The economy accelerated, everything accelerated from end of the world to, we're actually recovering kind of quickly, very fast. But the thing is, now I think we are kind of approaching the height of that rebound sugar high. And so going forward, things may not be as simple and as fast to continue in the recovery. Now, another reason to add to some of this caution is because in the market, a lot of times the market can kind of get caught up on year-over-year rate of growth. So, last year, everything tanked from a arguably kind of depressed industrial recessionary level, but tanked badly from there. And so then you kind of look out and, okay, say sales were down 50%, and then you look the next year, okay, sales up 100%. But the problem is, then you get back to kind of where you were before, and, if the next year sales only grow by 10%, which is still good, 100% the year before, 10% the next year, market can look at that and be like, ugh, we were pricing in way too much. And so at the same time, you have a number of places where the supply side, which was destroyed because of productivity, because of everyone cleaning things, can't have as many people in the region. And so the supply side could start getting back to normal. And remember also, a lot of people will say the cure for low prices is low prices, but the cure for high prices is high prices, because you have home builders talking about, okay, we're having trouble, funding because price of lumber, people talking about the record high price in steel. It hits demand as you know, it's great for the margins of the producers, but it can hit demand over extended periods of time, plus supply comes back. And look, you add to that, the world followed China. Like this whole thing, China was the first to shut down, China was the first to recover. And now what happened in China? Well, okay, they recovered. Then what? Well, then the market kind of has been struggling. Why? Well, because it accelerated very, very quickly, but now it's back to the slowing growth that was for a number of years before the pandemic. And so recently, China's credit impulse rolled over, and historically, that's not great for the rest of the world. And look, I'm sure many of you have seen these great charts of the PMI or manufacturing index or whatever, all those things that are, many of them, at their all-time record high. The problem is, these charts are mean reverting. Why? Because they look at things year over year. So record high in something that's mean reverting could be a problem in terms of where the future, where the chart's going to look like next year, because will it look as good as it is now? No. Now, I'm not saying that a mean reverting chart is going to cause problems, but you have to think, okay, so now there's a lot of super squeezes going on in terms of, okay, we weren't expecting something to happen this quickly, so it's kind of better than expected. And going forward, you know, the mean reverting, the higher prices clipping demand, and everything kind of ironing itself out may not be as positive in certain places as we're kind of thinking. And we have to think about how that ties into the broader market and what the broader market is moving on. Because the broader market, up until a few days ago, was at its all-time high. Now, some of the equities weren't. Some of the more speculative, more volatile, or just pick a random equity, some of them weren't. But the broader market was touching all-time highs. And so if we look at, okay, what would happen in a period of mean reversion, normalization, it may not be as up, and away as expected. Because remember, I just showed you the charts. We've our massive acceleration, but then kind of probably heading for a mean reversion. And the broader market doesn't go up 50% a year every year. It's not how it works, unfortunately, I guess. So we have to figure, okay, it was up a lot since the lows of last year. Can that continue? No. Okay, so how will that work out? Because you look at some of the tech stocks, big tech stocks in the US, and they've basically been flat for a year. That could happen. I would have no reservations against that. So the market doesn't have to go down, could go flat, I don't know. But overall, I think the summer seems likely to be a challenging period as we head into the summer and head into the back half of the year. And then we look at, okay, well, what might some of the warning signs that all is not perfect, what would they be? Well, gold, bonds, if they're going down in value, then, you know, things are getting better. Because they're supposed to go down when things are good. Problem is, they're not. And they're supposed to, but they're not. And so there could be a number of reasons for this, but it's a warning sign. Similarly, the US dollar, which admittedly has been falling a bit recently, it hasn't made new lows in many months. Now, you know, the chart doesn't look great now, to be honest, but it still hasn't made new lows. And similarly, some of the positive things haven't been making new highs. So let's look at some of those commodities. The positive things that, if everything is great, should be making new highs. Let's start with copper. So The copper price right now is basically high enough for any producer on the planet to make good money. Not saying it can't go higher, but that type of dynamic doesn't normally last forever because production comes online. Now, I'm sure people will say, okay, demand, yeah, demand's growing. I'll get to that soon. And people will also say, well, look at the last bull market. Copper price went up 5 times or whatever it was. And yes, it did. However, in the last bull market in copper, the marginal cost of production went up a lot too. Now, part of that is, oil price went up a ton, and that factors into the cost of production. And yes, grades declining will increase the cost of production of copper, but on a very short time scale, this is rather potentially extended. I think it's above the mid-cycle average. Now, it could easily go higher if things keep getting better and better at a better rate. Will they? From here, though, I think it's more challenging. And my thinking is a bit similar with oil in that, okay, we rocketed back to 60 bucks, and now OPEC is bringing back 1/4 of their production cut. So they still have, in theory, 3/4 just kind of waiting for the demand to show up. Meanwhile, at $60 oil, there's a lot of oil companies of various sizes that are talking about how they can grow production. Can they? Who knows? But there's some oil bulls that are saying, okay, look at these oil stocks. They're so cheap. They have massive free cash flow. They can plow it into share buybacks. The problem is, historically, giving oil companies free cash flow to do with as they please has been a later cycle dynamic. So if they can exercise discipline and not make more money, then it's fine. But otherwise, the cost of producing oil has come down so much in so many places, at least according to oil producers that have lowered and lowered and lowered their break even, that even now, even at $60, I'm not bearish per se, but I struggle to be too bullish. It could go to $75 oil, but I really don't see 100, at least for long, because there's a lot of places that it can come from. Now, all that's to say, I think the bulls really need these things to regather their momentum in the next few weeks. Otherwise, I fear that they may roll over. And if you look right now, the producers, the stocks look, to me, generally, broadly, worse than the commodity. So I think the commodities need to get to new highs to rejuvenate some of the momentum, because there was a ton of momentum before, and then it kind of faded out, and you look where the price is, and it is, medium to high depending on the commodity. And so it's hard to get from high to super high rather than from really low to high. And that's all I'm saying. So with all that said, my thinking is kind of, we have winter in the summer, in that things seem to be changing. Are they different now? I don't know. But heading into the summer, I think that a number of things will kind of cool off. And I also think that my biggest worry with the market is the grass is greener syndrome, in that, when we all get reopened, everything's going to go back to being amazing. And then we remember, okay, where were we in 2018? Oh, much lower than we are now. Okay, well, okay, so what's next, basically? So that's my main concern for the rest of this year. Am I calling for things going much lower tomorrow? No. But going forward, heading into the summer, I think things are a bit more iffy. So I'm sure a lot of people will look at today versus where we were 3 years ago and say, okay, it makes sense that the price is higher now in this shutdown than it was when the economy was doing good a few years ago, because we're pricing in growth. And so here's my problem with that. If you look at this chart, it will show you, I'll pick on copper. Historically, every 20 to 30 years, demand doubles. So I'm sure people are thinking, okay, so the price should double plus inflation every 20, 30 years, or price should just go up because over the long term, demand growth is good. It sounds good, although it may not be that simple. Because aside from the last super cycle, where we had a big inflationary boom led by accelerating economic growth around the globe, particularly in emerging markets. So before that, we had a period from the mid-2000s to the 70s where the price of copper was range-bound. It was basically flat. And you can kind of see there was a slight uptrend in the lows and a slight uptrend in the highs, but then kind of everything just exploded in the 2000s. And my point is, that's not every cycle that happens. And why is that? If demand does indeed double every 20 years, you look back at history and you think, okay, well, why hasn't the price just been going up and up and up like that chart showed? And really it's because, high prices are high enough for a lot of investment. So when the price is high, money gets spent. Then the price goes low. Because if the price stays high forever, you get infinite copper. So again, today we have to get to a point and we have to think in, okay, well, what are we pricing in? Well, the price is just above $4 for copper. And you look at, okay, well, what is the production coming over the next few years from the mines that are basically under construction? And I mean, this is what the profile will look like out to 2023. And, if $4 copper maintains, you'll probably get more and more going forward. So the question is, will we exceed that target? Or will we miss that target in terms of what actual demand will be? And that is today's outlook. For tomorrow's outlook, well, we have to decide, well, is the price of copper going to incentivize more production than we need or less production than we need? And which direction is that going? So I'm just saying that broadly, industrial metals are priced well above the cost curve. And this happens in expansionary times and, can go way, way, way above the cost curve. And in some, well, very few, it is way, way, way above the cost curve. But this is needed to incentivize investments. I'm just nervous about why is it far higher today when, a lot of people are constrained rather than 2018 or 2019. And I just pointed out that, okay, some of it might be growth or growth expectations. I think most growth expectations, which leads us to the question of, will we measure up to those expectations? And here are some of the cost curves to kind of show what I'm saying. The big one on the left, that's copper. So that shows most copper producers, $3, very happy, because most can produce all-in sustaining cost, $2, $2.25-ish. So now they're making great margins. And what are they going to do with that money? Well, perhaps reward shareholders, perhaps reward management, and perhaps invest in more production. Then we look at the cost curve on the right. Top right is steel, hot rolled coil. Well, okay, so the most expensive producers, around 600, maybe up to 700 US per ton. And we are now at, I think it was like 1400 or something. So again, amazing margins, great if you're a producer, but you know, a lot of new production can come in and be profitable even if it's like not the greatest production. So just a longer term thing to watch. Iron ore, bottom right, most producers can produce for $50 US a ton, and that gets you almost all the way up the cost curve, really. And so now we are significantly above $50 a ton, as we are in fact at $180 a ton. So again, even the worst producers on the planet have plenty of margin at this price. So this is really incentivizing a lot of production. And again, I'm not saying it can't stay here for a long time. It can. And I'm not saying that a ton of money can't be made in the meantime, because again, it can. I'm just saying that I'm concerned that right now expectations might be a bit high, and that if we undershoot the expectations, and if we undershoot them significantly, or it looks like we will undershoot them significantly, then some things, some, not all, may roll over. And if they do roll over, well then all of a sudden you go from, okay, we're not going to have enough, to potentially, okay, well, we might have too much. And if we do have too much, the prices need to go basically back into the cost curve, which means that they need to stop companies from producing more. And they would do that by basically making it so that they lose money. And remember, now they're making a lot of money, but if they will lose money, and they will at some point in the future, well, that could mean a significant move in price. And I'm just saying, if you look at some of the more big speculative asset classes out there, the weed, the cryptos, some of them look sick. And I'm not saying, oh man, that's so sick. I'm saying unhealthy, sick. And, you know, in some of them, they've surged a lot. And, well, they're kind of in no man's land if they start moving downwards. And the other part of my caution is, if you look at some, good companies, like broader market, just some good companies that deserve to be near their all-time highs, because there are some. And you look, and this is almost 10 years. Does this look normal for inside of a pandemic? Interesting. Good companies can do some good things, but I think some things have gotten a bit extended in the broader market. Now, I'm not calling for them to crash 100% or 90% or whatever. Just if you look at what a mean reversion might look like, it means underperformance for a while. And here's another one. This is John Deere, going back to 2011, 2012. I think you can kind of see what I'm pointing at in terms of an explosion of growth, explosion of expectations going forward. And, I'm not saying I'm not shorting anything. I'm saying that expectations are high. Now, to be clear, I am absolutely not saying sell everything, panic, market's going to crash, go to cash tomorrow. That is not what I'm saying. I'm not even saying this is going to be tomorrow. I'm just thinking that we are heading into a period where expectations are high and it's going to be difficult to reach them. I'm also saying that I'm looking at getting a bit more defensive. I'm trimming some cyclicals where the price is very extended. I am shifting to be a bit more defensive, and I'm doing that kind of with gold, real estate, utilities, that type of thing. And, I think it's important to know what you own, know why you own it, and know what you would do if it went lower. Would you buy more, or would you get frustrated and sell? And so I think thinking about that is important. In conclusion, I'm significantly less broadly bullish than I was a while back, and I would kind of say that I'm heading towards being broadly bearish. Now, I don't know if we get another pop higher. I kind of think we do, but it concerns me how many people seem to be thinking that we're going higher, either temporarily or permanently going higher. And so that's been making me a bit nervous recently. The other thing is more cautious towards the stocks that will eventually go down a lot. The high beta cyclicals that eventually will go down a lot. I don't know how else to say it. And the other thing, I really want to thank everyone for watching. I know this video will probably be met with a number of dislikes, and I really appreciate everyone who's gotten this far. But remember, it's not investment advice, but thank you and have a great day.